Good evening, participants. Investing is a complex process. It is more so in trying times like now, as geopolitical issues are in the forefront of any news. 40-year high inflation in the US and the Federal Reserve slotted to increase interest rates 4 times this year starting March are the odd topics of discussion in the investor community. As last 2 years, every investor looked like a genius in a market trending higher. Do-it-yourself investors have seen steeper drawdowns in their portfolio of late. Steering through trying times is the topic of discussion for today, and I'm delighted to welcome Mr. Dhaval Kapadia, Director, Portfolio Specialist with Morningstar Investment Advisors, with 23 years of experience in equity and fixed income. Morningstar is a financial powerhouse with a combined AUM of over 260 billion USD and present in 29 countries. Mr. Dhaval will throw some light on investing in a trying times like now. At the end of the presentation and the Q&A, a small survey will pop up on your screen, which will not take more than 5 to 10 seconds to respond. Kindly participate in the survey, which will help us to serve you better in the future. Now I hand over the stage to Mr. Dhaval. Mr. Dhaval, it is all yours. You can start your presentation. Thank you.
Thank you, Mr. Sivaraman. I think that sets the backdrop for today's discussion. So I've got a few slides on a presentation. So I'll just share my screen, and then we can get started. So obviously we've seen over the last 2 years, it has been sort of a challenging period, for humanity as a whole. In fact, not just the markets and the economy as such, but we've seen the challenges through the start of the pandemic and so on. And then just when we thought that the pandemic, so we must be the pandemic is in a way behind us, we are at a stage again where fresh crisis is sort of hit us in that sense now, which is the Russia-Ukraine crisis again. Obviously we all know it's a major humanitarian crisis as well. A lot of people, particularly in Ukraine, getting significantly impacted by this situation, and of course it has also impacted global equity and commodity markets, right? So today, what we'll try to do is we'll try and discuss and look at how this current crisis could further impact markets and what has been happening till date, and importantly, what our views are and how should you as an investor look at constructing or managing your portfolio during these kind of periods as such. So just quickly before we start off with the sort of the main topic of the discussion, a little bit about Morningstar. Of course, Mr. Sivaram did introduce the firm as well, but just a little bit more sort of a backdrop on that is that Morningstar was set up in 1984. This company is headquartered in Chicago. In fact, our shares are also listed on the Nasdaq Stock Exchange, which has gained a lot of popularity in recent times. The index is what I'm referring to. And initially, the company was started with the objective of providing data and research on mutual funds, for the end investors as such. Now, gradually we've expanded into many more areas and many more investment, solutions or research across multiple asset classes. Currently, the company we provide data on more than 600,000 investment products, and we're present in about 29 countries, employing sort of more than 9,000 people. But the core or the foundation of the company, in a way, the mission of the company is to empower investor success, and this is what it has been since the company was sort of started by a founder as such. And when we say empower investor success, what it means essentially is to create great financial products or solutions that help investors, reach their financial goals. And talking a little bit about the investment management group that me and my colleagues in India are part of. Now, this team or this group globally is responsible for providing investment advisory and portfolio management solutions to end investors, right? And typically we partner with advisors, with platforms such as PMS Bazaar to provide these kind of solutions to the end investor as such. And we're managing and advising about 260 odd billion dollars worth of assets. And again, the group has invested fairly strongly in the resources, right? I mean, this is obviously a people, investing is a people-driven business, right? So you need to have the right kind of investment professionals in place. So about 550 odd people within this group itself, out of which about 95 odd are investment professionals, right? Whose day-to-day job is to track markets, build views on asset classes, and manage portfolios and so on, right? And how do we sitting here in India leverage our global strength and our global resources as such? So the group is structured into three regions: Americas, EMEA, and Asia Pacific. And within each of these regions, there is a hub or a center of excellence that's identified, and the countries within that region work closely with that investment team in that region as such. So, for instance, within Asia Pacific, we have a large investment team at Sydney in Australia, and we work closely with our Australian investment team to build solutions for the local market and to sort of manage the portfolios and particularly the asset class views on an ongoing basis. Now, just moving on to what's happening currently, and I'm sure a lot of you are observing this otherwise in the markets, but just to give a snapshot of how global equity markets have performed, or major global equity markets have performed on a year-to-date basis. So this is from 1st Jan 2022 till as of yesterday, and here we're looking at equity markets across the world, and all of these returns are in local currency, their respective currencies as such. And if you start at the bottom of this chart, which you normally wouldn't do, but in this case probably yes, that obviously Russian equities have seen a major fall. They're off more than 40%. But along with that, we've seen particularly US markets, particularly the big tech kind of companies which comprise the Nasdaq 100 as well as the S&P 500 growth index. These have seen sharper falls as compared to many of the other markets. Of course, in India as well, we've seen mid and small caps fall more than large caps. So large caps, if you look at the Nifty 100 index, is off about 5 odd percent since the start of this year, whereas small and mid caps are down about 9 to 10% and such. Interestingly, Chinese equities or other emerging markets probably haven't, particularly Chinese equities haven't probably fallen as much. The fall is slightly muted because we've seen over the last year or so, particularly in 2021, we've seen a sharper fall in Chinese equities at that point of time. And also importantly, another thing to notice out here is that we've made a distinction between value and growth stocks, particularly in the US market where that distinction is more sort of clear. And we've seen that value over this period has outperformed sort of growth. The fall has been lesser as compared to growth stocks. So the value stocks will typically include the industrials, the cyclical kind of sectors, and the growth stocks are driven by the IT kind of companies, and the defensive or the consumer defensive kind of sector. So those have fallen a little bit more as compared to the value kind of sectors and stocks as such. And on the right hand side, you can see how the Russian currency has reacted to this crisis, and since about early Feb, it has fallen by about 29% versus the US dollar as such. Now, what is it that's driving markets, right? Of course, one of the concerns, again, you might have heard of or read about a little bit is the fact that Russia, in a way, is an important producer and supplier of several commodities, right? And here, what we've done is we've listed down major commodities and the share that Russia's share of commodity production for each of those commodities as such. And as you can see out here, in terms of petroleum, which includes oil as well as other refined products, Russia met about 16% of the world's requirements in that sense, and it is in terms of a single producer, it is the second largest behind the United States. In fact, even in terms of natural gas, Russia produces about 22% of the world's natural gas. And again, it's the second largest producer behind the US. And there are several other commodities, not just oil rated or not just industrial metals, but even if you look at agri kind of commodities, wheat, oats and barley and so on. Again, Russia is a major sort of supplier of these commodities to to the global economy and to global markets as such. So obviously, that's one reason why we've seen a lot of this volatility in markets and particularly in commodity prices, right? And out here, if you look at how commodity prices have moved, in fact, we've just gone back a little bit when we're showing commodity prices since the start of 2020. Effectively, of course, at the onset of the pandemic, commodity prices came off, and which is what you see on the left-hand side of the chart out here. Commodity prices, including crude oil, came off quite substantially at that point of time. And just for a brief moment, in fact, crude oil was apparently trading at negative kind of prices. Back then it was just for a very, very short point of time. But then effectively, since there has been obviously signs of vaccine recovery, which happened in mid 2020 or so, the expectations of vaccines being being made available to people across the world became little more apparent. We saw sort of commodity prices start to move up, and in fact, as you can see, anyways, before this particular crisis that we are talking about, the Russia-Ukraine crisis, even before that, commodity prices had moved up quite sharply, right? And of course, the crisis has even further pushed up these prices, but a bulk of that movement has happened earlier, and obviously this has been on account of a few factors. One is a stronger than expected demand recovery in many markets, right? Particularly developed markets such as the US, Europe. So there they've seen stronger recovery in terms of demand and consumption. Again, employment growth has also bounced back strongly, and alongside that, there have been supply constraints, right? I mean, the lack of shipping containers and so on and so forth, or in the case of semiconductors, again, you hear a lot about it. The supply not keeping up to the demand in that sense. So some of that was already pushing up commodity prices, and these have now moved up even further in recent times. Obviously, the biggest move in terms of commodity prices clearly is natural gas. Again, as we said earlier, Russia is a big supplier of this, and particularly to Europe as such. And natural gas prices have moved up by 375%. I mean, since Jan 2020. Most of the commodities, as we can see, whether it's crude oil is up 57%. In other industrial metals and inputs up about 50% and even food prices are up quite sharply. And this is more of obviously a recent move, also incorporated here, due to the ongoing kind of crisis. So obviously, markets are concerned about high commodity prices, and the reason they are concerned is obviously 2 or 3 reasons. One is its impact on inflation, right? And what we are seeing on the right hand side of this slide is how inflation has moved since about 2021, over the last about 1 odd year, in advanced economies, the developed markets, as well as emerging markets on the right hand side. And as you can see, and on the looking at first the chart for developed countries as such, you can see that here we've plotted how inflation in the US, UK, Euro area and Japan have been moving as such. And the dotted line in between that you see, the horizontal dotted line is at 2%, which is normally the inflation target that many developed countries tend to have, right? In India, obviously, we know it's a 4% plus minus 2% is RBI's sort of inflation target range. For developed markets, it is typically in the range of 2%. And as we can see in most developed countries, of course, in Japan also inflation has moved up. It is still at relatively lower levels, but in other countries, we've seen inflation move up quite sharply, right? I mean, US and as Mr. Sivram mentioned in his opening remarks, US is seeing probably the highest inflation rate that they've seen for the last about 30, 40 years or so, right? So which is quite a substantial thing for a country such as the US, right? And what that has done effectively is that it is pushing central banks to try and curb this inflation as such, or high inflation rates, because obviously high inflation eats into purchasing power and so on and so forth. And over a period of time, it is, if inflation stays very high, it's not good for the economy. So therefore, we are seeing central banks, particularly, the Federal Reserve and the Bank of England, indicating, monetary policy sort of, tightening measures or rollback of some of the measures that they had taken earlier, right? So, and this current crisis has even fueled inflation a little bit further. Uh, of course, along with this, what is also happening is that there are concerns around the economic impact of the current crisis, right? And in fact, there is a sense that the Federal Reserve might probably go a bit slower than what was expected just a few weeks back in terms of their, rate increases during the course of the year. So again, these are important for financial markets because, at least in the near term, because they will impact economic growth and so on and so forth. If interest rates increase, economic growth is expected to slow down a bit, which is what some of these central banks also want to try and curb inflation. But and this scenario is getting a little bit more complex with the current crisis that's coming. For India, fortunately, inflation hasn't been as much as a concern in recent times. I mean, for a variety of reasons. And as you can see out here, it is still within RBI's sort of target range. In and around that, it touched about 6% sometime back, and it's hovering around that kind of a level at this point of time. But RBI hasn't been. In fact, RBI, surprisingly, in its last monetary policy in early sort of February, indicated that they expect inflation to come down during the next financial year, that is starting April 2022. So they expect inflation to sort of come down as such. And if I were to look at India's situation a little more closely, on the left hand side you can see we've been talking of crude oil and crude oil prices moving up, and Russia's role in terms of supplying crude oil to the world as such. If you look at where India gets its crude oil from, I mean, India imports more than about 80% of its crude oil requirements, and the major suppliers for this, or where we import this crude oil from, is obviously the Middle East, including Iraq, and the US is also a big supplier. Fortunately, Russia is not such a big supplier of crude oil to us. Of course, in terms of other sort of oil requirements such as edible oil, about 13% of our edible oil requirements come from Russia and Ukraine as such. So obviously that is an area of concern, and more importantly, obviously the concern is the fact that a lot of these commodity prices have moved up quite sharply, right? And the higher crude oil prices haven't been still translated to end consumers as such. So end consumers are still not being impacted, or the petrol and diesel prices across the country in India at least haven't gone up as yet, right? And we know that's on account of the state election. So once that is done, there are indications that probably over the next week or two, from media reports, one would see that there is an expectation that petrol and diesel prices would be hiked in India very soon, right? Now, so that is an area of concern, definitely, that higher commodity, not just crude oil prices, but impacting other commodity prices also being elevated. How that would impact margins for corporates, and also the consumption sort of demand as such. If petrol and diesel prices are to move up substantially, it would result in higher transportation costs and feed into other forms of inflation. Whatever goods get delivered through transport, and most of them do, right? So those prices might also increase. So pressure on inflation from various fronts is what the concern is, and there is a likelihood that the RBI might, if this persists, the RBI might have to sort of relook at their inflation forecast or inflation expectation for the coming year. So effectively, they had estimated that inflation would come down to about 4.5% over the course of next year. So their estimate was that 4.5% as an average for the coming financial year. Now that seems clearly at risk given where the commodity prices are right now. And eventually, if they stay elevated, if RBI is forced to relook at its inflation forecast, they might also be pushed to try and look at measures to curb inflation. Could be hiking interest rates or reducing liquidity from the market. Some of it which they've been doing, but they haven't really moved away from an accommodative stance as of now. So they still maintain that stance. So that's an area of concern for for markets and for the economy as such out here. Just moving on. So we looked at what could be the potential impact of the current crisis. How markets have reacted, how commodity prices have moved, and so on and so forth. But if you just take a step back and here what we are looking at is that, and I don't want to look at the graph below. Maybe you could just focus on the table that's there, above the lines that you see across the graph. So what this shows is that over the last 15-20 years, the various geopolitical events that have taken place, right? I mean, and how have equity markets reacted? 3 and 6 months and 1 year over, 1 year down the line after these geopolitical events or scenarios sort of broke out in that sense. Now, if you look at, say, the Iran drone strike against Saudi Arabia, which I think happened in 2019, or you look at various other, you have Russia in 2014 also sort of annexed Crimea as such, and similarly if you look at the Iraq war or 9/11 as well. I mean, barring the 9/11 kind of event, for all the other geopolitical events, what we see out here is that over a 1 year period, markets have sort of in a way recovered, and not just recovered, they actually generated positive returns, right? Barring the 9/11 event where the impact stayed a little bit longer in that sense. So in other words, what we've seen is that over sort of a lot of these events have significant or probably have a larger impact over the shorter term. But as you move ahead, even 1 year down the line, they tend to be little, they tend to get dissipated, or the impact tends to get reduced over that time period. And that sort of in a way reminds us of a famous sort of saying from the Second World War, which said, keep calm and carry on. So that's how we view the investment scenario right now. We think probably there is a major impact, but this might be probably more short term in nature. Over the longer term, probably in some likelihood, the impact might reduce as such as we move ahead from here. So that sort of it gives me a sort of a segue into how we are looking at investments and what our approach is, right? I mean, how are we evaluating asset classes? Not just at this point of time, or across time periods as such, right? And the way we look at markets or asset classes is based on four pillars. These key pillars in a way drive our approach to investments, our views on and our outlook on various asset classes and markets as such. So the first pillar is we tend to look at the absolute valuation, right, of an asset class relative to its history, right? And I'll in the subsequent slides, I'll also show you some examples, or also show you, based on these pillars, what our views are at this point of time. But for the moment, just looking at each of these kind of pillars as such, the first, like I said, is absolute valuation. So, relative to its history, how is that asset class, looking like at this point of time in terms of valuation, right? So, for instance, if I were to look at, say, Indian equities today. So today, Indian equities in terms of valuations, relative to its history, are they looking cheap, or are they looking expensive? So that is the first factor that we try to understand, the first parameter that we try to understand, that today what is the price that I'm paying for the underlying growth expectation or underlying value of the security that I'm investing in, right? Relative to its own history, is it expensive or cheap, right? The second pillar that we tend to look at is relative valuation, right? So similar assets, so Indian equity, say, versus compared to US equities or European equities or other emerging markets, right? Or Indian large caps vis-a-vis mid and small caps, right? So how are similar assets? How are they looking like when you compare them to each other in terms of relative valuation, right? So eventually, if you have to invest, it's a relative game as well, right? You have to take a call for one asset class versus the other. Even if you take a cash call, it's still, cash versus other asset classes is what you would compare, right? It's a relative kind of a measurement that you would do. So that's what we try and do, is that on a relative basis, how, which asset class is looking cheap as compared to similar assets within that basket. So within equity markets, which asset class is looking cheap as such. The third thing that we try and look at is contrarian indicators, right? And you would have heard, I'm sure many of you are equity investors. You would have heard the term contrarian many times, right? And what we are trying to do out here is to try and see, which way is the market swinging, right? In the sense that when I say that, what it means is that, is there too much optimism towards a particular asset class? Are too many people buying into a particular, asset class or a particular market, right? Or people selling off from that market? Normally, what we see is that if there is a big rush for certain, segments of the market, or certain, which we saw, say, in the US, big technology companies over the last few years, we've seen a lot of people, buy into those stocks. And normally what we see is if there is a lot of optimism towards a certain asset class, which is indicated by certain parameters, it may show us that that asset class is probably overvalued, right? It may indicate to us, because there are too many people chasing that asset class. On the other hand, if there are too many people selling a particular, asset class, people are exiting it, it may indicate pessimism, and that's where we think, value can be found. So that's how we view contrarian indicators. And finally, fundamental risk. So, what is the underlying risk if I make an investment in this asset class? What is the potential for permanent loss of capital if I, make investments? Say today, if we were to look at, obviously Russian equities is an extreme example where today the potential for a permanent loss of capital can be pretty high, right? Given all the sanctions that are being imposed on Russia as such. So, in terms of valuations, obviously prices have come down quite a lot, but the fundamental risk can be pretty high if I'm looking at, markets such as these. So just quickly looking at some of these measures and the parameters that I mentioned to you right now, how are we viewing markets, at this point of time based on, say, absolute and relative valuations, right? So what we've listed out here is that our sort of return expectation over the next 5 to 10 years from various, major asset classes. And very important to note out here that these are real return expectations. So when I say real return, it's after inflation. So in the sense that excluding inflation, because to make them comparable across different markets, we take out the inflation factor from there. So we just focus on the real returns as such, right? Now, if you look at, and the other thing that we've done here is we've compared, as of January end. Of course, this doesn't entirely factor in what's happening in February, what's happened in February, but as of January end versus 1 year ago, so versus Jan 21, how these returns have expected returns have in a way changed over this time period. So if you look at this chart out here, we think Chinese equities probably are among the more attractive asset classes at this point of time. The expected return from Chinese equities is fairly high, which is the bluish kind of bar that you see out here. Is probably higher than most other markets as such. And obviously we saw, and this has improved over the last 1 year because, we saw a sharp correction in Chinese equities due to, some of the regulatory changes that were brought in, which impacted a number of the companies out there. But all considered, we think, in terms of return expectations, considering valuations as well, Chinese equities are probably among the more attractive, asset classes at this point of time. Similarly, UK equities to us also look, attractive, although the level of attractiveness has reduced a bit, because of, the performance of UK equities in 2021. Right now, if I move on, if I look at Indian equities as such, again, they're somewhere in the middle of the pack. They're not sort of, extremely attractive at this point of time. We've seen a sharp run up and we've seen, valuations move up as well. And that is why we're seeing, Indian equities not looking very attractive at this point of time. The return expectations are slightly lower. and on account of the strong rally that we've seen, of course, till the last few weeks where we've seen some sort of downturn, but broadly since the lows of March 20, we've seen a strong rally sort of in Indian equities along with other global markets as well. On the debt side, again, nothing very sort of exciting or interesting. I mean, probably emerging market debt is looking better than most other debt markets as such, is the way we see it. And US equities, just going back to equities a bit, US equities we think are not looking as attractive. Although we've seen some correction recently, but on a relative basis, they're still looking relatively unattractive to us. Now, quickly looking at what is it that's driving these return expectations. So generally, we tend to look at 2 or 3 key parameters, right? When we are looking at return expectations from various markets, right? And these parameters include earnings growth and cash flow growth expectations, right? So how are corporates expected to grow their earnings and cash flows over the next 5 to 10 years? Then we look at the dividend yields, right? I mean, what is the kind of dividend yield payout that we can expect from equity markets over the next 5 to 10 years? And then we look at the valuation impact, right? So are markets overvalued or undervalued, and how does that impact the return? Now, if I look at India, and this is just a breakdown of the numbers that you saw on the previous slide, the real return expectation from Indian equities, and this would have improved slightly with the fall that we've seen over the last few weeks, but is around 3% or so. Now, this is a real return expectation if you think inflation, and our inflation forecast is at about 5% odd. So if you add those two together, it would be about an 8 to 9% kind of return expectations from Indian equities, at this juncture over the next 5 to 10 years. Now, I know that doesn't sound very exciting, right? And the reason for that is the valuation factor. If you look at the dark green portions below, these are sort of in negative kind of territory. So in other words, we think, because markets have moved up and valuations have risen, and they're, probably above fair value at this point of time, this is reducing the return expectation from Indian equities. So the growth, which is, the light green portion out here is better than probably most of the major markets. Dividend yields are slightly lower, but the growth area is better. But valuations is what is, in a way, eating away at some of these returns, right? So for most, and this is true for most of the major markets where, the valuation factor is a bit negative. So valuations are, a bit on the higher side or above fair value, definitely in many countries, barring maybe a China, where, as we said earlier, we've seen, corrections and valuations are looking slightly more attractive and normalized out there. So therefore, the return expectations from China are looking a bit better. I know we're sort of slightly running out of time, and I'd like to keep time for questions. So I'll quickly go through some of the remaining slides. And, we spoke of the contrarian indicators earlier, right? I mean, what are they showing right now? Are they showing pessimism or optimism, right? And here, within contrarian indicators, we try and look at 2 or 3 parameters, which are essentially, one is in terms of the momentum score. So how has been the performance of markets, say, over the last 6 to 12 months? The second that we try and look at, so if essentially markets have done very well, right, over the last 6 to 12 month period, it acts as a negative, contrarian indicator that, there is probably a lot of optimism in the market if they've done very well over that time period. Similarly, the flows have been very strong, then again, it would be sort of a slightly negative factor for us when we're looking at asset classes, right, as a contrarian indicator, right? And then, what are the earnings growth expectations? Like in India right now, the earnings growth expectations over the next couple of years are pretty strong, right? So again, if there is any disappointment, and with some of it we might see now with the higher commodity prices, so the earnings growth expectations might come down, right? So therefore, at net, we are seeing that the contrarian indicators, although they've improved a bit recently, they are in negative territory, indicates that they are, it gives us a negative indication that they are not, positive in that sense. Obviously, if they are negative, but, it doesn't give us a very strong signal. So, we would be a little bit wary when we look at the indicators at this point of time. Although, there has been some improvement of late as markets have seen some correction as such. Now looking at a summary of all of this, right? I mean, if I were to put together, the absolute and the relative valuation, the confident indicators, so to say. What is the broader sort of what are our convictions or across major asset classes worldwide as such. So the way we show this is as I mentioned, based on conviction levels for each asset class as such. And if you look at the left hand side chart out here, you see that the major equity and bond markets are sort of covered here. We'll talk of India in the subsequent slide in more detail as such. But if you look at and how the conviction levels work is obviously if our conviction, if we think markets are not looking very attractive or a particular market is not looking very attractive based on the parameters that I mentioned earlier, absolute and relative valuations and confidence indicators, typically they would carry a low or a low to medium kind of a conviction as such. Now, US equity falls in that bracket even now because we've seen a very strong performance in US equities, over the last 7-8 years. There has been some correction, since December, but the fall is still not substantial. But, so therefore, on a relative basis, it's not looking very attractive, right? Whereas some of the markets that are looking attractive to us include, UK, Germany, China has got a medium kind of a conviction at this point of time, and emerging markets as a whole are also holding a sort of a medium conviction, from our perspective as such. On the bond side, although interest rates or yields have gone up a bit because of concerns around inflation and how central banks will react to that, but they are still at relatively lower levels, right? I mean, and therefore our conviction on developed market bonds is low, whereas we think emerging markets, particularly the local currency, debt, for instance, in India as well, we think, medium to long term, debt is looking fairly sort of attractive as such. And just talking a little bit more about Indian equities and what our view is on that. And as we spoke a little bit earlier that overall emerging markets we have a sort of a medium kind of a conviction. In India as well, we've seen sort of expectations of earnings growth and profitability improve, right? I mean, particularly over the last 6 to 12 months, and for a variety of reasons. One is measures taken by the central government, whether it's the PLI schemes, or we've seen a cleanup of the bad debts in the financial system, corporates deleveraging. So some of these factors, and we are also seeing some sort of a demand kind of a recovery. So these factors combined, in a way, is building expectations of an improvement in corporate profitability. Right now, if you look at and the left hand side chart on the top or here indicates corporate profits as a percentage of Indian GDP, right? So this peaked in financial year 2008, right? I mean, that was when, as a percentage of GDP, corporate profits were at about 5.5% or so. And since then, they've been on a downtrend. Obviously, you've had some periods when you've seen some improvement, but more recently, you've seen a bigger improvement come through. So, in other words, corporate profitability is showing signs of improvement, which is good for equity markets and which is in a way supportive to equity markets. And in fact, it's expected that over the next 2 to 3 years, this proportion will move towards its longer term sort of average as such, which has sort of not been the case over the last several years. And in a way, that has been driven by, as I mentioned earlier, strong earnings recovery and earnings growth expectations. Now, if you look at the chart at the bottom left hand side, you see the earnings growth expectations over the next couple of years are pretty strong, in the range of about 20 to 25% CAGR is the expectation that the rate at which earnings will grow the next couple of years. Now, there is a chance that some of it might be impacted because what we are seeing more recently in terms of commodity prices moving up, there could be a possibility that margins might come down. And we think, the markets in a way have priced in more of the optimism, right? And if you look at valuations and if you look at, the 1 year forward P as well as the PB, which are on the right hand side, you can see, the longer term average for the 1 year forward, Nifty earnings or P ratio is about 18.3 times. Whereas currently we are at about 20 odd times as such. And although this has come off a bit, the blue bold line has come down because markets have seen some corrections, but they're still trading above fair valuations. Even if you look at the 1 year forward price to book value, again you'll see that it's above its longer term average to a certain extent, and therefore at least the way we are seeing things is that we believe that, markets have priced in more of the optimism. Of late, some of it has come off because of the crisis that we are seeing out there. But they're still not, very attractively, or they're still trading above their fair valuations as such. Now, how does all of this convert into, our views, and what do we think is the right approach, sort of going ahead as such? And uh, you know, uh, we believe that to deal with scenarios such as these that you're seeing right now, and not just these scenarios, but I would say, from a long-term investor's perspective, if you're aiming to achieve your financial goals, probably a multi-asset approach is the best approach to follow. Is to diversify, your portfolio across asset classes, which are not only, Indian asset classes, but also, global, equity markets or global asset classes as well, right? And what we've done out here is just to try and, sort of, depict or show, how different asset classes have performed over the last about 10 to 12 years, right? And just to try and show you how, different markets perform in different market cycles as such. So, if you look at what we've done here is that we've put down the calendar year-wise returns for major asset classes worldwide on a, as I said, on a calendar year-wise basis, starting from Jan 2008. And again, it's a busy slide with a lot of numbers, so I don't want you to go through all the numbers. But what we've done out here is to try and simplify it, is that for each calendar year, the asset class that has outperformed or that has done the best, performed the best, is marked in a dark green shade, whereas the asset class which is sort of underperformed or has been the worst performer is marked in a dark pink or a red kind of a shade, right? So if you look at 2008, for instance, you'll see that Indian equities, this was the global financial crisis, and you saw global equity markets came off, but Indian equities fell more than, most of the markets at that point of time. But fixed income did very well during that year, right? So the interesting thing to note out here is that, one, it's very difficult to pick winners and losers on a year-on-year basis, right? If you look at, again, 2008, Indian equities was the worst performer, but the next 2 years it was again, the top performer as such, right? So you'll have these periods when, you see a variation in performance, and you see it's very difficult to pick, which asset class or which market would do well, in the coming or the subsequent year as such. Another thing to quickly observe out here is that when in periods when Indian equities haven't done well, other global markets have done fairly well, right? So if you look at, say, a period like 2013, when Indian equities generated a return of barely 5%, developed markets, led by US, were up by about 50%, right? And all of these returns are in rupee terms as such. So it factors in, particularly for global assets, it factors in, the rupee movement as well. So, not just 2013, but even if you look at, say, 2019 as well, even European markets did fairly well, during 2019, when Indian equities sort of underperformed as such. And if you look at the annualized returns, since 1st Jan 2008 till, as of 3rd of March, which is yesterday, you'll see that, developed market equities, in fact, driven by US, have done better than most of the markets as such, right, including Indian equities as such. And along with, the returns, we've also put down the drawdowns, right? What is the downside risk in these asset classes? And again, you'll see that, other markets have probably, the downside risk or the drawdowns tend to be slightly lower than in case of Indian equities as such. And along with all of these, we've also included a multi-asset portfolio. Essentially, this is a portfolio which is a combination of about 40% Indian equity, 10% global equity, right? That is 50% equity in total, and about 45% debt and 5% gold, right? So like a 50-50 kind of a portfolio. And we've seen how it's performed, over the last about 12 years or so. So you can see out here the performance has been more steadier. In fact, it's done better than many of the individual asset classes, and the risk in terms of drawdown has also been relatively lower as such. So you've got, reasonably stable returns, and, which have done better than several individual, markets or asset classes as well as such. So, therefore we think, a multi-asset kind of a strategy is probably best placed, for investors, planning for long-term goals as such. And, just very quickly, so in terms of the strategies that we offer in India, these are a set of 4 multi-asset portfolios. And as you can see out here, these portfolios invest in a mix of asset classes, which include Indian equity, fixed income, and international equities as such, right? And each of these portfolios is suited for different investment horizons and different, risk appetite as such. So if you have, say, a 5 to 7 year horizon with a moderate kind of a risk appetite, a balanced portfolio would be suitable for you. And as your investment horizon and risk appetite moves up, the other, the allocation to equities and growth assets tends to move up as such, right? And uh, within each of these buckets, the allocations are further split, right? So Indian equity, we invest in large, mid, and small. International equity, we are investing across US, Europe, and emerging markets, and fixed income across, short, medium, and long-term debt and cash in the portfolio. So the idea is to try and look at opportunities across different asset classes, right, and not just focus on a single asset class, because as we saw on the previous slide, the winners and losers keep changing. There are other asset classes that will do well, or certain asset classes that will do well at certain points of time. So therefore, we think it pays to be diversified across various asset classes in a portfolio. The other thing that we try and do out here is we try and invest more money in an asset class that is looking attractive at a point of time, and lesser money in an asset class that is not looking so attractive. So therefore, you see ranges around for each of the asset classes. Like if I look at the growth portfolio, the domestic equity allocation would be in a range of 40 to 70%, debt in a range of 20 to 50, and international equity in a range of 0 to 30. So if I find, and like I was mentioning earlier, that probably Indian equities are looking a little bit expensive, and particularly say mid and small caps, so I will reduce my allocation to mid and small caps and probably put my money in an asset class that is looking more attractive. For instance, it could be emerging market equity, or it could be debt as well, if I find that is looking more attractive at this point of time from a risk and reward and a valuation kind of perspective. So that is how these allocations, these portfolios are sort of structured in that sense. And typically, as I was mentioning, these allocations will move based on our views. So typically, in what scenarios will these allocations change, right? When equity markets are disappointed, when valuations are looking reasonable, is when we will reduce our allocations to debt and cash and add more allocations to equities and other growth assets, right? And vice versa, when markets have done very well, we will tend, and valuations are looking stretched, we will tend to reduce our allocations to growth assets such as equities in the portfolio. So in a way, it is in a way contrarian, but it's valuation driven as well is the approach that we would be taking as such. And just finally, looking at how, say, we are positioned in the portfolios right now, and some of it which I was mentioning earlier, this is a snapshot of how the aggressive portfolio is allocated as of date. I mean, as of end of February. Large cap allocations, and so there are two bars that you see across for each asset class, right? So one is we refer to as the neutral allocation, and the second is the actual allocation. So what does the neutral allocation mean? Essentially is that if we think large caps are trading at their fair valuation, in the aggressive portfolio, we will invest about 48% to large caps. Similarly, if mid caps are trading at fair valuations, we'll invest about 13% of the portfolio in mid cap. But currently, like I mentioned, we think small and mid caps in particular are looking a bit expensive, after this strong rally. So the actual allocations, which are the green bars, are lower than the neutral allocation. So mid cap currently is at about 11.5% versus 13% of a normal allocation or neutral allocation. And small cap is about 6.5% versus 7%. Large caps we think are looking fairly valued, so the actual allocation is similar to what our normal or neutral allocation will look like. Similarly, US equities, we are still sort of underweight, whereas we think emerging market equity, if you look slightly below, you'll see that emerging market we are overweight versus our normal allocation. Similarly, debt, some segments of debt we think are looking reasonably attractive, so we are sort of overweight some of those segments as well in the portfolios as such. So just to sort of summarize, the solution that we are offering and the benefits that it can provide in a way is that one is a start to end solution. So you can see, right from the decision on how much to invest across asset classes to the underlying security selection to constructing and reviewing the portfolio will all be managed by us. Again, you have different options suited for various sort of risk appetites and investment needs as such. Also, you are able to sort of leverage our global as well as local portfolio management expertise, and finally lower cost as compared to some of the other investment solutions in the marketplace as such. So that's a nutshell on the proposition. And just to sort of wrap up with a summary of what we discussed, right, over the last about 40 odd minutes. Effectively, of course, we've seen this situation has dramatically shifted investor sentiment. The Russia-Ukraine crisis. There's been a lot of volatility in markets and a lot of sort of negative speculation. That is something that we are obviously all observing. Energy prices is obviously an area of concern, for most people. But as we saw from particularly the chart where we showed, how markets have moved or reacted, 6 to 12 months after, some of these geopolitical events, we've seen that it sort of dissipates. So some of these concerns tend to reduce, as time goes by, and therefore we would, still follow the mantra of, keep calm and carry on, so to say. And we believe that a long-term approach, to investing can obviously help, against making unwise kind of decisions which are driven by more, short-term fears and concerns. So we think, therefore, as an investor, it's important to follow a slightly more long-term approach, to investing and try and look at, the impact of various events on the fundamentals and valuations rather than just, react based on, a short-term sort of market movements as such. So that's the way we are approaching, this particular scenario at this point of time. So I'll stop here and I'll hand over to you, Mr. Sivaram. If you can take questions.
In fact, my biggest takeaway is between 2008 to 21, while equities gave the Indian equities gave 8.5%, multi-asset portfolio has outperformed by 2.1%. This is the biggest takeaway for me. Let us get into the questions now. Mr. Jagdeep Sharma is asking this question. My wife is considering to start a PMS. And should she wait for a month or two to considering the volatility now, or do you suggest this is the right time to invest in a PMS fund?
Yeah, I mean, I would assume that you and your family have a long-term horizon, right? I mean, that's the reason you're looking at investing into PMS, whether it's an equity or a multi-asset PMS such as ours. So whichever it is, I mean, I'm assuming that it's for a long-term goal, right? So if it's a long-term kind of a goal, then I wouldn't really hold back the investment. In fact, on the contrary, when you see market volatility, it brings up opportunities as well, right? So I would think that, you don't need to hold back, assuming you have a long-term horizon. Like I said, when markets correct is the time when opportunities come up, right? And at best, if you want, you could, stagger the investment. I mean, several PMS, in fact, we have a liquid strategy as an option where, the money can be parked, the corpus can be parked into, a couple of liquid funds, and we could do an STP into, the main portfolio as such. So if at all, that could be one option that you could look at. But, given the volatility, I wouldn't, necessarily suggest you to hold back the investment. On the contrary, I would say the opportunities would tend to be, greater when we see, this kind of market volatility as such.
And Manish Narang, he has asked a string of lot of questions. And one question I found very interesting. RBI has forecasted 4.5% as inflation target. Is it tenable, or do you think 4.5 is less than what is expected to happen in the future?
Yeah, I think, the RBI made this projection a few weeks ago, in early February in their recent monetary policy. At that time, obviously, you didn't have this crisis in a way, and the crisis came our way, a few weeks after that, and more recently as such. So, therefore, the RBI probably is also re-looking at this situation. But net, the markets felt that, probably RBI's forecast of inflation was probably a slightly lower than what market participants were expecting. So, obviously, RBI had their rationale. One of the key rationale was that as other central banks start to increase rates and tighten monetary policy, right? I mean, which is what the Federal Reserve and the Bank of England have also indicated, right? I mean, once they start to do that, economic growth could slow down, and that could bring down economic prices, commodity prices as such, and that would eventually bring down inflation even in India. So, but at this stage, of course, it seems very debatable whether a 4.5 can be maintained. It seems a little bit difficult, particularly if commodity prices stay elevated as they are right now. I mean, crude oil prices have obviously moved up sharply and so on. So we think that RBI will also be watching that number also very closely.
The corporate profit to GDP is substantially low compared to US. Do you think your projection for Indian equity returns is little less than what is expected, as the kind of the profit growth is expected to be very good with a growth of 7.5%? Indian economy is likely to grow. And what is your input as the corporate profit grows? The returns from Indian equity will get better?
Yeah, they should. I mean, definitely, there is no doubt that India will be among the fastest growing economies. I mean, that is the expectation at this point of time. But the challenge, as if you are, if you saw in that earlier slide that I am showing, is that markets in a way have priced in some of this near-term optimism, at least. There. So therefore, if you look at valuations, they are slightly above normal or fair levels, and therefore that is pulling down the return estimate at this point of time. So yes, but as you go into the longer term, as you go say beyond 10-15 years kind of period, the impact of valuations tends to reduce, right? But we believe that over next, even over 5 to 10 year periods, valuations play an important role in terms of driving both returns as well as risk. So therefore, given that valuations are slightly rich, at this point of time, the return expectation is slightly low. But in fact, at this point, and the person also mentioned US equities, but the return expectations are better than in case of US equities at this stage, right? I mean, given that probably US has had a much stronger run up over the last 7-8 years as such.
The long-term returns, and in fact, at the 18.3% which you told, the premium has come down drastically. And do you think still it has got scope to come down, or is it is likely to go up? Is what an investor wants to know, as the premium has come down from 80-90% to less than 10% now. What is your input?
Yes, I mean, with the recent correction in markets, but although keep in mind that markets still haven't fallen very significantly. As we saw the year-to-date number, Indian equities are off, maybe about 5 to 10%. I mean, obviously, certain stocks, certain sectors would have, fallen more, but at a market level, that's what the fall has been. So, I mean, if you ask me, it's obviously very difficult to try and time the markets and say, all right, this is the bottom or this is the peak. Every time you try and do that, the markets will always surprise you. So I wouldn't try to hazard a guess, but I would say that, and I would say probably return expectations where we are sitting today, right, given where markets are today, are probably slightly lower. And this is what we showed in the previous slides as well, that the return expectations are lower because valuations are still slightly richer, although the extent of that overvaluation has come off a bit, as we saw in the previous slides, but then it is still above fair value. So I would, in a nutshell, say that return expectations are still slightly lower, and although they've improved marginally, but they're still relatively low.
The government borrowing program is going to get fattened now, with the bond yields are going up. What is your outlook on the debt side of Indian market?
Sure. Yeah, I mean, I think that's an important part as well, right? A lot of people tend to ignore what's happening on the debt side, but we think debt plays an important part in any portfolio. It not just, I mean, it acts as a cushion to the portfolio. At times, it can generate superior returns as compared to equity, which we saw in the, in that slide where we had the calendar year-wise returns as well. Debt doing well in some of those periods. But just coming to the current scenario, yes, there is a concern around, particularly of late, those concerns have increased with commodity prices moving up and with concerns around inflation rising. So with those kind of concerns increasing, obviously there is a likelihood that the government might have to relook at its borrowing program and things like that. But it's too early, right? I mean, bond markets yields have gone up a bit over the last few days with the higher commodity prices and so on. But again, both the government and the RBI are aware of this situation. I mean, they are seeing all of what we are seeing and probably trying to understand it a bit more as well, right? So they are aware that they can't allow inflation to move up too much. They are aware that if RBI is forced to increase interest rates, it will impact growth negatively, right? So given that the government can take some supply side, some measures in a way to try and address some of these issues, right? And I'm sure at least what one understands from media reports is the government is prepared to look at different areas. For instance, just on the petrol and diesel prices, there are some indications that the government might look at cutting the taxes on petrol and diesel, right, which we know comprise 50 to 60% of the price is going towards taxes, right? So because the underlying price might need to go up, right? I mean, but they might cushion some of that impact of the underlying price of petrol and crude going up by reducing taxes. So in a way, although the overall price might still go up, but it might be a little lesser than than people expect, because they might reduce the taxes. So in other words, they will be looking at ways to try and address these kind of concerns. But just coming back to the debt market, in fact, we think that the medium to long duration, the 5 to 10 year kind of segment on the debt side looks fairly attractive. So we think the real interest rate spread. So if you look at, say, the 1 year treasury bill today is at roughly about 4.5%, whereas the 10-year government security is at about 6.8%, the yield on that, right? So the differential between these two, which is about 2.3% kind of differential, which we refer to as the term spread, right? What you're getting for holding a 1 year paper versus what you're getting for holding a 10-year paper is much higher than what it has been historically. So historically, that spread is in the range of about 100 to 150 basis points, or 1% to 1.5%. And today it's at about 2.3%. So therefore, we think that the 5 to 10 year kind of segment looks relatively attractive, from an investment perspective.
See, there are some inputs that we have overreacted to these geopolitical issues, and in the Indian context, what is your input? Do you think our investors have overreacted by selling the recent correction? What is your input?
I see. I don't think it's without reason, right? Because what's also happened is that you have to look at the recent correction in the context of what has happened over the last 2 years, right? From the lows of March 2020, markets have moved up by more than 100%, right? I mean, small and mid caps are up by 130, 140%, and so on and so forth. So the rally has been pretty strong. Now, even if you look at, currently, if you look at the last 3 or 5 year returns, these numbers are also looking fairly decent, right? All about 15, 17%, small and mid caps even better. So effectively, what I'm trying to say is that the performance has been very strong. The returns have been very strong. And this is on the back of strong earnings expectations from corporates, right? That the recovery has been decent in India. Corporate profitability has improved. The government is taking various measures and so on. But along with that, the earnings growth expectations are pretty high over the next couple of years. As I mentioned, earlier as well, that at least for large cap companies, the earnings growth expectations are anywhere between 20 to 25%. Right now, with what we are seeing on the global scenario, commodity prices even moving up further, if they persist at those levels, those will impact margins for corporates out here, right? I mean, they will their profitability will come down, right? So therefore, I wouldn't say it's without reason, or I wouldn't say the reaction that you've seen out here is an overreaction. I wouldn't really say that. There are definitely concerns, but these concerns might be more near term in nature.
The next question, and what is your allocation to China in the current portfolio? And there is a sub question to that. How often you relook at the allocations to various components in your portfolio?
Correct. Yeah, I think those are very two good questions. I mean, particularly the second one is, so just to address, the the question around how often do we relook, and I'll also address the question on the China exposure as such. So typically, because, and as you would have seen, through some of the slides where we said that the returns that we are drawing or the return forecast that we are drawing are for longer term periods, right? 5 to 10 year kind of a horizon, right? So given that context, these return expectations don't change very significantly with small market movements, right? With a 2, 3, 4% market movement, these return expectations may not undergo a change. In other words, the point I'm trying to make is that typically the allocations might see a change if we see market movements in excess of 10-15% up or down. So that's when we may change some of the allocations, based on how the markets have moved and based on how our, return expectations and risk expectations in a way have changed, right? We review the portfolios, every month, the allocations, but the changes don't happen every month. Review doesn't mean a change. It just means that we are re-looking at or just trying to see, how whether our risk and return expectations have changed and so on and so forth. So typically that activity is done on a month-on-month basis, but the changes are not so frequent as such, is what I would say. And to the second question around allocation to Chinese equity, so we have some allocation in the. So there are two ways in which we have exposure. One is through the emerging market fund that we hold. So about 30-35% of that emerging market fund is in Chinese equity, and we hold about 3 to 4% of the emerging market fund. And in the aggressive portfolio, we have a pure China equity fund of about, with an allocation of about 2%. So if I were to add the two up, it is about 3 to 4% allocation to Chinese equities in the aggressive portfolio as such.
Mr. Dhaval, a lot of other questions have come. We don't have overshooted the slotted time by already by 10 minutes. And I would like to thank the participants and Mr. Dhaval for an excellent presentation. I thoroughly enjoyed it. I hope you would have enjoyed it as much as I have done. Thank you very much.